Market psychology. Stock market psychology refers to the ability to identify and manage emotions and behaviors that may arise while trading. While the stock market is a forward-looking indicator for expectations around corporate earnings performance, it is often also swayed by factors which influence trading psychology on individual and collective level. Three factors to consider are investor mood, market sentiment, emotions such as greed or fear. The aim of this video is to explain the importance of trading psychology in the stock market and to provide additional knowledge and tips on how this can be managed. What is market psychology? Market psychology refers to prevailing behaviors and aggregate sentiment of market factors at any point in time. The term is often used by financial media and analysts to explain market movement that may not be explained by other metrics such as fundamentals. Market psychology describes the overall behavior of market based on emotional and cognitive factors on net and should not be confused with trader psychology, which refers to the same factors but that affect just a single individual. Takeaways. Market psychology is the consensus sentiment of the market as a whole based on the aggregate of individual market participants. Greed, fear, anxiety, and excitement can all contribute to market psychology. Conventional financial theory assumes that prices were always based on rational considerations and fail to account for potential irrational impact of market psychology. Understanding market psychology. Market psychology is considered a powerful force and may or may not be justified by any particular fundamentals or events. For instance, if investors suddenly lose confidence in the health of the economy and decide to pull back on buying stocks, the indexes that track overall market prices will fall. The prices of individual stocks will fall along with them, regardless of the financial performance of the companies behind those stocks. Greed, fear, expectations, and euphoria are all factors that contribute to markets' overall market psychology. The ability of these states of mind to trigger periodic risk on, risk off, in other words, boom and bust cycles in financial markets is well documented. These shifts in market behaviors are often referred to as animal spirits taking hold. The expression was coined by John Maynard Keynes in his 1936 book, The General Theory of Employment, Interest and Money. Writing after the Great Depression, he described animal spirit as spontaneous urge to action rather than inaction. Conventional financial theory names the efficient market hypothesis, EMH, is criticized as not accounting adequately for market psychology. It describes a world in which all players in the market behave rationally and fails to account for the emotional aspects of the market. But market psychology can lead to an unexpected outcome that can be predicted by studying the fundamentals. In other words, theories of market psychology are at odds with the belief that markets are rational. Fundamentals drive stocks' performance, but market psychology can override the fundamentals, pushing a stock price in an unexpected direction. In market psychology, there are broadly two prevailing methods of stock picking used by professionals, and only one of them pay much attention to market psychology. Fundamental analysis seeks to choose winning stocks by analyzing the company's financials within the context of its industry. Market psychology has little place in this number crunching. Technical analysis focuses on the trends, patterns, and other indicators that drive the prices of a stock higher or lower. Market psychology is one of those drivers. The trend following quantitative trading strategy employed by hedge funds are an example of investing techniques that rely in part on taking advantage of shifts in market psychology. Their goal is to identify and exploit discrepancies between an instrument's fundamental and the market's perception to generate profits. Market psychology research. Studies have examined the impact of market psychology on the performance and investment returns. Economics Amos Tversky and Nobel Prize winning psychologist Daniel Kahneman were first to challenge the conventional market theory of the efficient market. This is, they did not accept the notion that humans in the financial market will always make rational decisions based on publicly available and relevant information and prices. In refuting the notion, they pioneered the field of behavioral economics. Their theories and studies focus on identifying systematic errors in human decision making that stem from cognitive biases such as loss aversion, recency bias, and anchoring. Their work has been widely accepted and applied to investing, trading, and portfolio management strategies. Frequently asked questions. What does market psychology teach us? Because the market factors are human beings, markets are an aggregate of human choice, can display herding behavior and other irrational tendencies such as panic selling and irrational exuberance that leads to asset prices bubbles. By acknowledging the existence of market psychology, we can understand that markets are not always efficient or rational. How can people use market psychology to their advantage? By doing your own research, you can identify when market psychology emotions like fear or greed result in oversold or overbought conditions. You can then make contrarian trades, buying when others are selling and selling when others are buying. Research can help you jump on trends early, but not chase trends after they've gone past their fundamentals. In which markets is market psychology present? Market psychology applies to all asset classes from stocks and bonds to forex, interest rates, and cryptocurrency. How can one gauge market psychology? There are several indicators of market sentiment that can one look at, such as the VIX, which measures the implicit level of fear or greed in the market. Technical analysis tools can also be used to reveal sentiment in a market based on historical price, action, and volume. What is a sentiment indicator? A sentiment indicator is designed to represent how a group feels about market or economy. These market psychology based indicators attempt to quantify sentiment in the form of figures or graphically to predict how current beliefs and positions may affect future market behavior. Sentiment indicators look at how bullish or bearish market factors and what they are thinking and feeling, which may help forecast investors' future behavior. When sentiment readings are unusually high or low, they may begin acting in a contrary way. For example, when investors are extremely bearish, that is often a contrary signal to sentiment indicators, traders, that market prices could start heading higher soon. Key takeaways. Sentiment indicators gauge market psychology in the form of investor or consumer behavior and beliefs that may influence the market. When a sentiment indicator is moving in the same direction as what it is analyzing, that typically helps confirm that trend. Extreme readings on sentiment indicators may cause some traders to take a contrary view. For example, buy when there is fear, sell when there is greed. Sentiment indicators are used to analyze trends, assets, and the economy from the perspective of the participants involved instead of just looking at an asset or data point isolation. What do sentiment indicators tell you? Sentiment indicators can be used by investors to see how optimistic or pessimistic people are about the current market or economic conditions. For example, a consumer sentiment indicator such as the Michigan Consumer Sentiment Report shows pessimism may make companies less likely to stock up on inventory because they may fear that consumers will not spend. The data is subject to interpretation. A high reading shows consumers are upbeat, yet from a high reading, some feel it will likely head lower over time. A low reading shows consumers are downtrodden, but from there, things are likely to improve. Sentiment indicators are just one piece of data and are not meant to be timing signal for taking action. For example, if a sentiment indicator such as the put-call ratio has a very high reading relative to historical values, that indicates investors are expecting the stock market prices to decline. The contrary aspect indicates that prices will likely rise because there are a few people left to keep pushing prices lower. What the indicator doesn't tell us is when that will happen. Instead, the traders use data to watch for turning points in price when sentiment levels hit extremes. When sentiment indicators aren't near extremes, they can help confirm the current trend. For example, a rising put-call ratio signals investors are pessimistic, which would help confirm a downtrend in prices. Similarly, a falling put-call ratio would help confirm a rising price. Policymakers may use sentiment indicators with other economic data to help determine the future direction of interest rates. For example, types of market sentiment indicators. Investors can use sentiment indicators to gain insight into the stock market's mood. Extreme readings given by these indicators can indicate impending reversal. Here is a small sample of the sentiment indicators that traders and analysts might use. CBOE Volatility Index, VIX. Investors view this indicator as the fear index because it spikes when investors purchase a significant amount of put options to protect their portfolios. Investors who buy put options believe the price of the underlying stock will fall. If the VIX spikes, it indicates a fear within the market. New York Stock Exchange NYSE High-Low Indicator. Investors can keep track of this indicator to compare stocks making new 52-week highs relative to stocks making new 52-week lows. Spikes in either direction often show extreme bullish or bearish sentiment. Contrary investors might use this sentiment indicator to buy quality stocks during periods of severe pessimism. New York Stock Exchange 200-day moving average. This indicator shows how many stocks are trading above their long-term moving average and is expressed as a percentage. For example, if the indicator is rising and shows that over 60% of the stocks are trading above the 200-day moving average, it indicates a broad bullish sentiment. A reading over 80% suggests stocks that may be overbought. Odd lot trading statistics. This indicator measures the number of shares being bought and sold in odd lots, which is less than 100 shares for most stocks. The theory behind this sentiment indicator is that retail investors who typically have the least amount of money are likely to buy and sell odd lots, but when bullish sentiment has peaked, and sell when bearish sentiment reaches a climax. Therefore, when odd lot trading increases during market extreme, savvy investors may take a position in the opposite direction. Commitment of Traders Report. This weekly report shows aggregate positioning of different groups of traders in the futures market. A rising speculative position indicates a rise in the asset's price. When speculative interest hits an extreme, though, it indicates that prices could head the other way. Sentiment indicators versus technical indicators. While some sentiment indicators will also fall under the heading of a technical indicator or vice versa, sentiment indicators are meant to show how consumers or investors have positioned themselves or what their current beliefs are about the economy or market. A technical indicator is a broad term to describe the formulas that manipulate the price of volume data and sometimes other types of data of an asset to provide a different perspective on what's happening on price volume chart. Limitations using a sentiment indicator. Sentiment indicators are not timing signals. An extreme reading to the commitment of traders report doesn't mean the price of the asset will immediately reverse. Extreme readings can remain in place for a long time, or the price may stay where it is while traders unwind their positions and the extreme reading disappears without a significant price reversal. Sentiment indicators are best used in conjunction with other forms of technical and fundamental analysis to help confirm market or economic turning point. For an example, an extreme bullish sentiment reading coupled with extremely high price earnings ratio or deteriorating fundamentals as well as a breakdown in price provides more conclusive evidence of an independent downtrend than acting on sentiment alone. Stock trader psychology is not a theory, and the only way to learn is by experience. We can't read books and become excellent in understanding that easily. Market psychology differs from time to time according to market participants. If you follow a crowd psychology, sometimes you end up winning, and most of the time you will fall into the trap set by institutional traders. For example, sometimes you feel the stock hits the resistance and it's going to fall when you enter a short position. It will shoot up to the moon. Next time you will think history will repeat, and now it goes to the exact opposite. Both the time one thing is similar, which is you fell on that trap. This time, whatever stop loss you place is hitting all the time. It means you got trapped on a stop loss hunting point. Now you got confused about which you should follow. Here the psychology play. You have to act exact opposite where institutional traders set traps for retail traders, as is a zero-sum game. You have to connect your emotional intelligence with your trade, and you should stay disciplined in your personal life because of your personal emotions. Weakness will reflect on your trade. Analyzing previous patterns and your trapped experience and make notes of it. You have to practice in the way of how institutional traders think, and you will start grasping the emotional patterns and ideas of what's going on in your trade. You have to be emotionally stronger than the peers to find the opportunity and avoid your personal emotional weakness reflects in your trading system. Our catchphrase is study it, analyze it, adapt it. Peace.